Welcome to episode 16 of the PetroNerds Podcast. My name is Ethan Bellamy. I'm the co-host. I work at BP Capital. And Trisha Curtis is the CEO of PetroNerds. Good to see you again, Trisha.
Yes, good to see you too. It is still May 11th? Tuesday?
It is still May 11th, Tuesday. Yes. We're back to back because Digital Wildcatters staff is going on vacation, I believe. Yes. So we're getting them 2 episodes this week. So let's dive in. We are going to talk about E&P and Oilfield Services consolidation. And we're specifically going to dive into Diamondback, EOG, Pioneer, and Liberty. So let's start with consolidation. We've seen 3 big deals lately. We saw Laredo Petroleum take down Sabalo for $700 million and change. We saw EQT take down Alta for close to $3 billion. And then we've seen Extraction and Bonanza Creek join in a merger of equals to create Civitas.
Yes, Civitas, man.
Civitas. So that is going to have an impact on lots of stuff, but consolidation as it pertains to the service industry is kind of interesting. So where do you see consolidation headed, and what do you see the impacts as, Trisha?
Well, I think it's a bit different. So consolidation for these companies. So it's interesting to me because Extraction and probably Bonanza Creek should have happened a long time ago. Right. I mean, this is a long time coming. So when folks talk about like where I get questions from clients and stuff of like where we're headed for consolidation, not just for upstream, but also for, the service side. This is interesting because for Colorado, and we really do probably need to spend a couple podcasts just strictly on the Colorado space, but Extraction and Bonanza Creek, it helps them from a resiliency standpoint for sure, because they're now the single biggest operator. They'll be have the biggest footprint and be the biggest operator in Colorado, but their production has dwindled for both of them. But it helps them from a standpoint of having acreage, being able to drill, being able to do stuff. And it does help them from a standpoint of actually working with the government and the legislative and everything. So, but it was a long time coming. In terms of what it moves the needle on, not much, because the Colorado is honestly a crappy market, and we've seen production just continue to decline.
The rock is good.
The rock is good.
The regulation.
Yeah, DJ Basin is from fantastic. You can drill cheaply. You can punch out these wells. They're not 3,000 barrel a day wells, but I mean, if the DJ Basin was never a bad basin, it was just honestly, it's the political and regulatory environment to work in. So they're not a great example of in terms of saying what is the implications to the market. But that consolidation does mean they're going to do less, but they've already. Color's just a bad example because there wasn't much less that they could do. So the impact to the service side and things like that aren't the same. The other things that happen, and we'll talk about this, but Diamondback has closed on their, so they closed on the Guidon, which I always think of Guyana whenever they say that, but they closed on the Guidon acquisition and on the QEP acquisition. So, and then obviously Pioneer has purchased Parsley and Double Point or Double Eagle, and people say both of them in their earnings call, so it's not just me. So they closed on those acquisitions, and from the Permian perspective, as you pointed out in our previous podcasts, and whenever I'm talking about rig count and everything, which by the way is still crushing it, when you point that out, you say, well, it's different in the Permian, and it certainly is. So when we're talking about consolidation and we think about Extraction and Bonanza Creek and EQT and all these. The implications for consolidation, I think, in the upstream space are different in the what the impacts are going to be, and all the impacts that we're going to have to see in the market for Permian are very different than if in the Bakken. And we are seeing that consolidation in the Bakken. I mean, Diamondback is selling they've sold their Bakken assets. Yeah, they sold $745 million in assets in the Bakken. To Oasis, yes. Which just came out of bankruptcy. Yeah, so that's like crazy. So so many people, all these companies coming out of bankruptcy are doing this stuff, and Oasis is buying up this stuff, and so Diamondback mentions in their earnings call that those are positive tailwinds for them, right? They got a decent purchase. So the Enerplus, the Oasis, those aren't small price tags that they're paying for this stuff. So PDP is obviously the value for PDP, and Diamondback mentions this in their call, is that, the value for PDP is high, and it's hot right now. And that's
so do you want to get into the Diamondback call, or do you have other thoughts on the on consolidation?
Well, it's part of the consolidation. So we'll just flow. We'll flow right into the
So I should disclose that BP Capital is long in our energy fund, Diamondback, EOG, Pioneer, and EQT, all of which we're going to talk about.
I am actually, and as a personal investor, I think I've said this in previous podcasts. I think I said the first podcast. I bought EOG a long time ago at the split at $98. So I am technically long as well. And underwater and long. And I lost everything on Oasis because when they declared bankruptcy, I lost everything. So that was a few grand.
So we should be clear, this is not investment advice.
This is not investment advice. We're not
We're just talking about industry trends here.
So in terms of, and they are interesting. So the reason I sort of picked, obviously we'll get into it. So
let's start with Diamondback.
Yes. But they kind of go together. Flows together. So Diamondback, EOG, and Pioneer, and then Liberty Oilfield Services give you a pretty decent picture of the state of play in the industry right now. So Diamondback, I think they're interesting because they're a very well-run company, and they have it put together. So they talk about scope 1 and scope 2 emissions quite a bit. Not quite a bit. I mean, they just piggyback on their previous earnings call. I picked up that so if you listen to EOG, Pioneer, and Diamondback, in terms of the three of them, you hear more about the energy transition in terms of, and the scope 1 and scope 2 emissions and what they're doing on carbon capture and everything, or what they may do in the Diamondback call than you hear in the others. And I think that's an interesting standpoint because I think we do have to start thinking about these companies. And I give credit to H.L. Hunt's wives on this because we discussed this about giving credit to.
And for those of you who are not familiar with what she's talking about, this is an anonymous Twitter
Twitter person, individual, smart as hell. And we were talking about the valuations of operators against each other from a energy transition standpoint. So essentially from a GHG emission standpoint, is that these operators are going to start competing. They are competing against each other on from an emission standpoint of who's better. And I think Diamondback, they're clearly trying to lead on this front, right? That they want to be ahead of the curve. And I think from a regulatory standpoint, it's really smart because they're actually doing quarterly flyovers, which I haven't heard any operator say they're doing that. So they're going to do quarterly flyovers to basically double check that everything they're doing on their tank batteries and everything is helping from an emissions standpoint. So they're working they talk about
specifically what are they tracking? So they're looking at emissions, fugitive emissions.
So they're tracking their methane emissions. So that obviously it's reducing flaring is one, and then it's actually tracking all the fugitive methane emissions. So they spoke about it in their previous earnings calls that they were investing, a certain amount of dollars per well for these, especially in some of their older wells, to basically get everything up to snuff and get it working. And then they announced that they're basically going to hit their scope 1 and scope 2 emissions for following global accords for scope 1 and scope 2 emissions. And that furthermore, that they purchased offset credits to basically be in neutral, that their barrels would be neutral. So they talked about it a decent amount, and they're ahead of the curve. Now, in terms of that. And the reason I say that I think the stuff on your tank batteries, and talking about your tank batteries specifically, one, it's important to note that because I think that this is an example of a company that's ahead of the regulatory stuff, that the industry can do it. This is literally making sure your tank batteries are up to snuff. Not every company is going to be able to afford to do flyovers and checking their methane emissions. But the fact that it can be done from a technical standpoint is really important to know.
Yeah, and by the way, you don't need an airplane. It's great if you've got a huge field, but you can just take a FLIR gun and a pickup truck and look at your assets.
Right. So, I mean, there are ways to do it, but the point is that they're addressing it. Now, from a broader picture. So they basically said they're going to spend, or maybe this, they have a chunk of capital they're going to invest and continue to spend within just the scope 1, scope 2 emissions, continue to buy offset credits. Then they talk about carbon sequestration and advances and stuff they're investing in. And they basically say it's clear they're going to continue to invest in it, that the space is going crazy, that they're following their peers, and they'll be doing stuff that makes sense and works and everything. They're a little bit less, I think, on the make sense side than on we're going to invest in it and we're going to reduce our emissions. I think the more make sense and stuff is EOG and Pioneer kind of talked about that. And I think that's where I've realized that Diamondback they do talk a lot about, how they are structured as a company, how the capital efficiency, how they want the market to view them. I mean, everybody talks about that, how they want the market to view them, but it's a little bit different with them. And this is certainly a piece of that, how they want the market to view them. They want to be not just viewed in an oil asset class, but they want to be, in the broader, they want the generalist investor to be to be buying into them. So their production's like north of they're 250,000 barrels a day roughly for production. They closed on the Guidon and the QEP assets. They obviously had the advantages for the purchase price with the PDP, and they are maybe looking to sell some additional acreage that here and there if it's favorable to them. It doesn't. Whether or not they'll go out and purchase a bunch more I don't think that's going to happen immediately. But they also talked about the efficiency stuff was really relevant in their call. So they talked about the efficiency gains that they had from the QEP purchase, what they've learned from them. So they said essentially they checked their egos at the door with all their purchases of these companies, and they bring in they bring in the teams in house, and then they learn from them. So with QEP, it was really about water-based drilling mud. So that they said that QEP was very efficient on the drilling side, and now they are actually integrating the water-based drilling mud as well. All of these companies, to some extent, talked about longer laterals. I think part of that's because they've been having these acquisitions and they can, they talk about blocky acreage and being able to drill longer, but longer laterals and, the efficiencies on the frac side. So certainly for Diamondback, they're definitely drilling longer laterals.
So interestingly, the way I think about the ESG aspects of E&P are really twofold. One, there are the funds who aren't necessarily looking to divest all oil and gas stocks, but they are going to require you to check all the boxes on sustainability and corporate disclosures. And, are you working on scope 1 and scope 2? And then there's a whole bunch of ESG investors who just aren't going to own any fossil fuel stocks. So there's sort of two layers of the onion here. I do want to point out, there's a little bit of a digression. I tweeted a new paper in the Journal of Asset Management from a guy named Lauren Swinkles. He's a professor who wrote an article about who owns tobacco stocks. At BP Capital, we've been making the argument that oil and gas stocks are going to look a lot like tobacco stocks did, and underowned and certainly underloved by the mainstream press and regulators, but performed pretty well for a long time because the market still demanded them. And we think there's a similarity there. Do you see Diamondback as a natural further consolidator in the Permian?
I do think so. I think that if push came to shove and there was a purchase, I'm just looking at their map again. They're not exposed essentially at all on the New Mexico side, but they have a very nice footprint now.
Which is good because you don't want to be.
It is. For
at least for the next 4 years,
yeah,
right?
At least for the next 4 years. So they have a good footprint. I could see if it's bolt-on, if it's blocky, if it fits within their portfolio, I could see them doing it. It's 418,000 net Midland and Delaware Basin acreage. So it's a decent amount. So that's essentially half of Pioneer, but it's a huge chunk of acreage. And then they, I think it was one of the guys in the earnings call said, I've never gotten in trouble because they're asking about well spacing, and they do talk about doing all the wells at once. So that's what we've learned. You can't be doing these wells a chunk of, one reservoir and then come back to the next one underneath it. But they talked about doing, I think it's the first Bone Springs that they're doing, tighter, but then the second Bone Springs may be a little wider. And the guy said, hey, look, with these asset purchases, and I think to an extent, all these earnings calls essentially echoed the same point, is that we have more acreage and therefore we're not changing up our well spacing. But I think it was in the Diamondback call, they said I've never gotten in trouble for drilling a bad well. So if it comes on good and you're slightly wider spacing, then that works just fine. I could see them as they're one of the bigger players, right? So they are a natural further consolidate. I just don't know how far that's going to run. Their production. Okay, so I'll correct on the part. From an oil, I love it when companies break out oil barrels per day as opposed to BOE per day, because the Permian is very, very gassy and it's a completely different story, especially now with higher oil prices. I think it's important to break it out. But they went from, their Q1 2021 is 184,000 barrels per day. So honestly, they're 200,000 barrels a day for oil production. I could see them in a way wanting to grow that. They do say that, you got to think about their maintenance capital as well now. And so this gets to this hedging thing, is that, they were asked about hedging in last quarter's earnings call, and they said, yeah, we're going to continue to hedge. And then they mentioned in this earnings call that they are not, that they're basically for the full year, they'll lose about $450 million on hedges given the current strip. But interestingly enough, when they're kind of pressed on hedging and stuff, it's not like they want to throw it completely out. I mean, and that's very different from Pioneer and kind of different from EOG as well, is that Diamondback is a little bit more nuanced in their approach. And again, this is, I think, how their executives approaching Wall Street and the market. They're more nuanced in saying, OPEC still has barrels offline, and this is a commodity business, and this is oil, so we're not, necessarily out of the woods. And I just think it's a little more honest, in terms of like, you don't know what oil prices are going to do. Yes, you can be comfortable. This is a comfortable place, but hello, we're coming off the back of minus 37 last year. So
right. So tell me what oil prices do under this scenario. A new variant emerges in the U.S. We get lockdowns again. And the Fed has to taper because inflation takes off. Yeah, what are oil prices look like?
You're backsliding like
$45, $50.
Exactly. And then those hedges that Diamondback look really freaking amazing. Yeah. So there's a hedge. I mean, I think that we have to just be careful is that you're hearing this a lot, and this comes back to our previous podcast that we've done, that this sentiment that's emerging from, in the U.S. oil patch is very robust. It's that everybody's going crazy and they're going strong and things are going to be really good. And you just have to be careful. The other theme, I think, from this is that and you echoed it when you started this, is that the fiscal stance of these operators you said that in the previous podcast. So these operators are not outspending, at least the Diamondbacks, Pioneers, and EOGs.
They have the free cash flow religion.
Yeah, they're going to spend.
At least for now. Yes. I love it.
Well, they say this is their guidance. They're going to hit their guidance. I think what's tricky and what they're getting asked about in their earnings calls is would they increase production? If the whole philosophy is to not increase production, then why are they doing these asset purchases? And it's honestly kind of a fair question of that. If your goal is to not increase it, and Pioneer says basically we're not increasing, we should be purchasing these guys so we can consolidate and gobble up the small guys, and then they won't increase production. But last thing I'll say just on Diamondback, I mean, so the drilled lateral feet, I think, has gone down a smidge, and that's only because I think some of these actual purchases, they talk about not drilling longer laterals for the sake of drilling longer laterals. So if you track their average, if you look up Diamondback and you look up their average lateral length in the Permian Basin, you can see that they outperform and crush their peers on average length in a lot of counties. But the importance to note on this is because every single company is drilling longer laterals, and we're hearing increasingly talk about 2.5 mile long laterals, 15,000 foot. We're talking about and pushing 3 mile long laterals. So every call is talking about this, and you hear this in the Liberty call as well, and other service companies. And so the point of this is that we've said it before, it sounds really simple. It makes a huge difference in terms of if all your large independents are drilling, pushing 3 mile long laterals, or let's just say they're pushing 12,000 feet on all their wells, they're drilling less wells. So they're getting the increment. And as long as the performance, they're not getting diminishing marginal returns on those end feet. And that's not going to be everybody. But it's something these guys know.
What is the technical upper bound of a lateral length?
So it's been like we've seen, I think they've tried to test it in the Marcellus and stuff, and in Ohio is like 3 miles. And that's what we're literally hearing operators say we're going to be doing 3 mile long laterals because we have blocky, nice long acreage positions. And the advantage to them is that you're just drilling less wells, so you're reducing your costs. I think a few years ago, you would have said, there was a lot of hesitation. We didn't see that. One, because we didn't have the acreage put together perfectly a few years ago. And two was because people were concerned about completing the end of that lateral. Not that the completion, you could technically do it, but, what would the drill out look like? And it was always the toe. It was always the very end. Was it going to be perfect? And I would wager we haven't seen enough of it yet. We haven't seen enough 2.5 and 3 mile long laterals at, consistently, especially with these simultaneous fracs and everything, to say, are they really not having diminishing marginal returns? But, it really depends on EOG talked about it depends. It's situational for them. That they'll choose to do it when it works, and they tick more about the geology. Other operators like Pioneer are saying, no, this is what we have, that blocky acreage, so this is what we're going for. So I just think it's absolutely something when you think about the overall trend of the market. So when you think about consolidation and you think about big operators like Diamondbacks and Pioneers and stuff buying companies, blocking up their acreage and then drilling longer laterals, the implication is that it does have a domino effect on the entire service industry, meaning that you do need less rigs, meaning that you are doing more with less. And in turn, you need less frac fleets. And we'll get to this with Liberty, but I think that's a really important thing to think about, is that you just need less. And we're already doing less. And so everything in their call is like efficiency, efficiency. And I always say Diamondback, at least a couple quarters ago, used to talk about like, for every penny saved, it is $1 million of free cash flow. So I thought that was important that's how they're thinking about it. So, but interesting to listen to. And I think they're doing well overall. I mean, they're good operators and they seem to be crushing it, and, kudos to them. So.
Okay. Well, let's move on to, if you're done with Diamondback.
I think I'm done with
check now.
Yeah, I know you do.
If you're done with Diamondback, let's move on to the widely acknowledged leading independent EOG.
Awesome. Yes. And EOG is a little broader because they're not a pure Permian and pure player. So they do have their foot in other basins, particularly Eagle Ford and William, but they're not really active in a lot of other spots. So yeah, EOG, double the title of their slide, and I'm not ripping on them, but you kind of have, it's shifting to double premium. So Ethan, I think, mentioned this in one of our previous podcasts when we talked about EOG, is the double premium, but it says higher returns, lower declines, more free cash flow. They're honestly, EOG is known obviously for being one of the leaders and pioneers in the industry, and obviously being the company to model in terms of for shale, both from a technical standpoint, from a geology standpoint, from rock, everything. And it is really interesting how they're leading in this U.S. independent space, because they have not. I do not think they've leaned in really hard into the whole ESG thing. And the reason I say that is because, I listened to all these calls, and you can know how much they actually talk about it. And I personally don't think they need to. Now, they need to work on the same stuff like Diamondback is doing. They need to work on keeping their barrels low on emissions, and they need to, being able to validate that. But they, when you're making money and you're making returns and you're crushing it.
Special dividend. Yeah. I love that. Yeah, special dividend.
They talked a lot about that. It was
I love it.
$1 a share. And it was kind of like, hey, kudos to you if you own our stock. Now, they also, what was interesting is they were asked about that. Like, oh, did you get that because you got high gas prices during the storm? And they were like, we got $40 million from the storm. So it wasn't, it was $600 million that they dispersed on the dollar thing. And so this dividend thing is another serious component to this, is that all these companies have a different perspective on how the variable dividend. Most companies.
Which started with Devon.
Yeah. So.
And I tweeted at the time that I thought it was brilliant, because these are inherently highly cyclical businesses. And however you want to approach it, I think a variable rate dividend based on your actual quarterly profitability makes a ton of sense.
The trickiness, and I think the EOG talks about, is that they don't want it to be they want a consistent dividend.
Well, of course they want. I want a hot fudge sundae every night for dinner, but that'll make me fat and lazy. Well, that's just not how the business is designed.
I know, but so Pioneer is the other company that was big on it last summer, right? That's saying, hey, we're going to do this so you'll have our dividend, plus you'll have this variable dividend. That's great, but your shareholders still want to know. So you should, you're fighting a battle that and Pioneer's had a decent stock price and everything, but you're fighting a battle where nobody loves oil and gas. You're fighting to be in a long only portfolio. You're competing on the ESG side. You have to have these low emission barrels. You have to do all this stuff, and you have to have a dividend that's sustained. That's kind of difficult to do when you've got a hedge, but then you lose your money on hedging.
And I'm just going to throw it out there. Sustainable, ratable dividends for E&Ps, if you're not ExxonMobil, and I've even said Exxon's dividend, that's suspect. Yes. They're overspending on that. I just think it's not a good idea. And in fact, we saw the whole midstream space, which has much greater revenue visibility and should be much more stable. With just a few exceptions, we saw cuts in all those payouts. That ended up being a lot more cyclical than people either wanted or marketed it to be. So in my view, sure, maybe pick some sort of base dividend and then a variable component. But the idea of over promising stability is, I think, not achievable really in this business. And I think it's bad to entice people with that lure and not be able to deliver.
Exactly. And I think that this is why I thought it was interesting. I have to revert back just for a second on Diamondback, because it was interesting when it always comes back to hedging a little bit. It's like, well, so they get this pressure on the hedging stuff, and you've done these companies are big now, right? You're talking a couple 100,000 barrels a day. I mean, for Pioneer, crap, we're talking, 700,000 BOE a day. So these are huge numbers, right? And EOG is producing north of 400,000 barrels a day total as a company. So we're talking about large numbers as a company. We now have this thing called maintenance capital. So you have to have enough money to maintain your production levels, right? And to maintain all this stuff. And that's why they end up hedging. And part of this whole maintenance thing, though, you can look as a company, is also your dividend. And so oil prices are great. They feel awesome now. We're at 65 WTI, but came off the depths of, last year and minus 37 WTI. So you have to realize that it's just taken from a perspective. I mean, the fact that these companies are doing well, I mean, a part of it is just the broader momentum for energy and oil prices going up, and, this confidence. And they all mention that, every company is talking about how, the tailwinds and everything, and how oil prices are great, and they're feeling good about stuff. But that it's not necessarily the actual dividend and the variable dividend are just, I wouldn't say the variable is suspect, but it's that there's a reason why they call it variable. So it's nice if you have it, but it means that these companies have to, they have to be managing their portfolios really well. They still have to be drilling really good wells. They have to be, crushing on that. And so you can't have crappy wells anymore. You can't sort of, that just didn't perform. And because you have quarterly guide, you're hitting production guidance. And then you're saying, are we going to grow? Are we trending up single digit growth is what we're seeing. All these companies, by the way, are growing at least a little bit. Their maintenance, they were down last year, and then they maintained their production pretty much. And now they're going to be growing a smidgen, essentially, which means the companies that they purchase from the consolidation, back to the consolidated companies they purchase, they're not going to be ripping and roaring. They're going to pull that back a little bit, so they'll need less frac fleets, less drilling and everything. But it comes back to this. They're now big companies, and they have to maintain that spending, which is that from a long-term trajectory. When I tell my clients and what I tell the service sector is, look, it might feel a little rough in the short term when you have the consolidation because there's a pullback in activity, but in the long term, it's really good for the steadiness of the Permian Basin.
Yes, and let's step back even further and marvel for a second, shall we, at U.S. independent companies drilling unconventional wells and being and producing free cash flow.
Yes, yeah.
Positivity. So set aside the variable versus fixed rate dividend policy.
Yep.
And marvel that we're talking about actual dividends to begin with. This is great. This is incredible. We've come out of this shale boom and bust and massive spending. It looks almost like the recovery of the remaining tech stocks after the tech crash, when you had this massive amount of spending and euphoria, and then the glitz and glam collapsed, and now here we are with actual healthy, profitable companies making sound investment decisions and buying back stock and paying dividends to shareholders and paying special dividends. This is great.
Yeah, and it is, and it kind of gets. I take it all the way back from that positive standpoint and that resiliency in terms of one, it's a reality. Whether you think you should be adding rigs or not, that's still happening. And whether you think these companies should have survived or not, they did. So they went through, bankruptcies, and they're emerging. But the companies like Diamondback and Pioneer and EOG, they were never going to go bankrupt. So we weren't worried about that. But they're actually making money now. So now they're making money. Now they're going to start competing on the ESG side. So there is a resiliency story here, and they're not dropping production, so they're not declining output. And this is the piece that I do concerns me that OPEC is going to miss. And it's not that we're going to grow like crazy, but it's that we're not going to reduce our production. And I don't think we're going to be declining production. I think EIA had come out, what was it, that we'll be declining 20,000 barrels. So basically we're saying flat at 11 million barrels per day. Is that the numbers that they came out?
And then they were up a little bit next year, but not a huge growth spurt.
No, and that's the trickiness here a little bit is that so when EOG talks about their shift to double premium, it is the 60%, it's a 60% rate of return. So it used to be a 30% rate of return, right? 60% rate of return at $40 oil. So $40 flat WTI is basically what they're looking at. And it used to be 30% return at $40 oil. So That was their shift to double premium. They update their inventories. They say they have basically 10 years of running room from that standpoint, and they have some of that double premium in all their portfolio. Now, that allows them to basically, they can start selling off things that are not double premium. They say that they're going to start selling off, and they do say, we can call BS on this, and we can say, okay, EOG 60. That just sounds ridiculous.
60% at $40 oil and $2.50 gas, no less.
Yeah. So they have to kind of be crushing it in their wells. And I do think that whether or not some of this is a little pie in the sky or not, EOG has done a very good job with the rock that they've had. And they have done a very good job executing on it. So when they drill wells, they crush it, and their performance is good. So I think it's from the efficiency standpoint and the trends of the industry and where it's going, I think people should be concerned when EOG is talking about longer laterals and efficiency gains and cost reductions, which every single company talks about cost reductions. So does Liberty as well. We're talking about free cash flow, all these things, and cost reductions and 65 WTI. And they say, hey, yeah, we'll probably have service costs rising and everything, but we're going to offset it with efficiencies. Now, massive inflation, everything that could be offset. But the fact that they're going to say they're offsetting it, that's a pretty big deal. I mean, the fact that we're in 2021, to your point, we went through all this, hell back and forth, and we're here. And then you've got these big boys who've not only survived it, but are thriving in it. Even with all this pressure on them from the market and the ESG and the green revolution. That to me is the really global, but the real bifurcation in the world of oil still going. And so is, green tech and everything still going. But these companies, in my opinion, are going very strong.
They are. So do you want to talk more about EOG or move to Pioneer?
I want to get to you saw the thing on the efficiency. Okay. So it's on EOG. They have a slide and they talk about like the drilling longer laterals.
Which slide for the folks at home? It's
slide 11 on their investor deck. And so it's sustainable well cost reductions outpace inflation. So this is the comment that sort of everybody's sort of making is that, regardless of inflation that we're going to see and they're hearing more about the service cost inflation than they're actually seeing it. And in terms of the actual service providers coming to them and jacking up their prices. And I think that is coming from, we did see previous quarters, I think, where the service guys tried to increase prices. That did not go over very well with folks, coming off the back of what they were coming off. So they didn't do that. And then what you are hearing from the service sector from multiple calls is that they basically, you still have companies in the play. So you still have too many companies, obviously, in the service space, and they're undercutting pricing and they're still going after market share. So all that's still benefiting the upstream guys. And you're seeing that, but they're also saying, hey, we're drilling so much faster now. We're completing, 3,000 lateral feet per day. And the fact that we're able to do this and we're speeding up on efficiencies from all these metrics, we're offsetting it no matter what. And that's just something that happens in every downturn. Everybody gets better. We tend to be going better. And we weren't drilling that long laterals, in the Delaware before, and drilling times were slower and everything. And everybody sort of caught up, they got the best guys and now they're all speeding up and we're seeing that. So EOG talks about drilling longer laterals, more wells per pad, in-house engineering, drilling motors, simultaneous operations, offline cementing. This simultaneous operations. So when everybody's talking about these simultaneous fracs, it's when you basically are fracking. You're fracking twice as much. So you're fracking 2 wells at once, but you're not using double. You don't have 2 frac crews on site. You basically have 1 and change. So maybe it's like 1 1/4, and you're not using twice as much horsepower. But the point is that you're doing this at once. So it's a time standpoint, and then this, I think, to me, has probably the biggest. This and the sand side has the biggest impact on the service sector, because Liberty talks about having 2, basically they say we're maintenance frac fleets, so about 200 frac fleets for the U.S., and that they have 15% of those, and that they're fracking about 20% of the wells. So they have 15%, so it means what? They have roughly 30 frac fleets. No frac company is fully, like, all the frac crews are not fully dedicated, meaning that if Diamondback has 5 frac crews, they're not using all 5 all the time. And then take into account this, if you're doing simultaneous fracs, you don't need as many frac crews as you did before. It's kind of interesting to me that, one, we didn't do this sooner, that we weren't doing more of these simultaneous operations sooner. I think part of it is pad development, is that we always think it's Exxon and it's, 24 wells, together. But most of these guys are talking about, how on average their pad has increased from 2 wells to 4 wells to 6 wells. So we're getting to the point to where they can finally do this, and they're doing multiples. And incrementally, I think this is looking like, I would say probably 20 to 25% of the market of fracs are these simultaneous fracs, which has gone up from like nothing. That's going to have an impact. And so from an inflation standpoint of like getting workers, the tightness, you've asked me this before and I didn't have good answers, but I think they're seeing real tightness now, like trucker, everything. One, partly because they can't, the unemployment benefits are definitely impacting them. But it's really interesting because on the sand side, I think this whole mining locally. So you had a lot of sand companies go bankrupt, right? And, sand warehouses and everything, last mile solutions. Local sand mining is something very real in the Permian Basin. A handful of companies are doing it, but I think it is the trend. Like, I think by year end, everyone's going to mention it.
And just for the folks who aren't familiar with the history of proppant, we went from you have to have perfect sphericity.
Yes,
you
ceramic, man-made proppant.
Northern white or whatever. You need the perfect stuff too. We'll just take any old sand near the well.
Yep. Well, it's not even any old, it's the same. So the Permian happens to have the geology that it's the same sand that they have at the sand mine, except you don't have to mine it. I think we mentioned this in like the very first podcast that we did. I'm going to give a shout out to a company because I'm going to have them on the podcast, is Nomad Proppant. And they are one of the local sand mining companies that the coolest thing about this, folks, is that the companies are going to reduce their ESG footprint because the OSHA standards of like the air quality and having the microscopic stuff. It's wet sand; they're not drying it, so you reduce the heat usage, which is your from an energy content side. So you're reducing that, and then you're using the wet sand. So you're solving multiple things, and then you fix the last mile solution, so it's right there. And think about if you're doing these simultaneous operations. That's really, really needed because they're fracking so much. They need so much sand, so much demand pull right now. And that's where I think we're starting to see tightness. So these are really, from a nerd perspective, these have such huge, profound implications for a market. And they're awesome because think about it. What if you can, I guarantee you can probably do this in North Dakota because we went from this we have to have perfect spherical sand and we got to have the conductivity. And so we had man-made ceramic proppants. And then, EOG really pitched. It was the first one in the business really to start using local sand mines that was their own mines. And they had bought Northern White. They'd actually had mines in Wisconsin and the Midwest. And then they owned that, but they started using local sand in preference, partly probably because of transportation, but also because they thought it worked really well. This small, crappy 100 mesh pumping down their wells worked awesome. And that evolution, took forever. And I've had a gazillion conversations on this, but it took forever for people to finally recognize sand quality really doesn't matter, or to an extent it doesn't matter, but basically you can put very small mesh sand. In fact, it probably does better in a lot of these wells. And so the reality is that when they started mining locally, local mines in the Permian, now it's just it's just an extension of that. You have the geology, basically across the Permian Basin. And so you can mine by the well site. And I think Laredo was actually testing this out with the company it wasn't Nomad, but Laredo was testing this out a few months ago. And I think we're going to see it as companies start doing it and then the big boys see it, you're going to see every one of these guys. And by the way, not even with the sand, just with the simultaneous fracs and I believe it's Pioneer that mentioned it, is the $200,000 to $300,000 in well cost savings from longer laterals and these simul-frac operations per well. That's $300,000 per well. So these are relatively in terms of when you're getting your well cost down to 5, 6, 7 million, this stuff adds up. So
basically the old theme, technology, best practice, deflationary is offsetting the general inflation that's out there. So the marginal cost of production isn't necessarily going up.
Absolutely not. And you actually hear that that's the whole game, right? You hear that within the Liberty call too, is that, look, we have efficiencies. And that's the most incredible thing about all this to me is that every quarter, this stuff is changing. Honestly, if you're talking to guys on the ground, I really, people have started calling us about wanting to get on the podcast. If you want to get on the podcast, I need a field trip to the Permian Basin, and I want to see it. But I think it's important when you're talking to folks in the field, it's very different from, even just the earnings calls and how quickly it's changing. But it has such a profound impact because it changes so quickly. It's like okay, so a couple companies start using this local sand mining and then that starts taking off and it changes. Well, how long is it going to take OPEC to understand that? How long is it going to take the Saudis to really understand that these efficiencies and the costs and everything are offsetting all this stuff? Because I guarantee you the Saudis are looking at this saying prices are going up, service costs are going to go up soon, and this just isn't going to go anywhere.
And your view is that they have the same myopia of vision that some of the U.S. forecasters have about prices going through the roof because we aren't spending enough money to drive supply, which is they fail to see the efficiency gains happening in the U.S. and they got wrong production coming back in 2020, right? Exactly.
And I think so this gets to, we can kind of round out EOG, but so EOG kind of says, well, they have a slide 13 that says no growth until market clearly needs the barrel. So they quote themselves saying that. So they're saying they're not going to add any growth until the market. So, that means OPEC.
Defined by price.
Yeah, well, they're saying demand recovery to pre-COVID levels, inventories at or below 5-year average, and low spare capacity. So that doesn't mean we're waiting until OPEC brings all the barrels back. That just means we're waiting until it looks really good and they brought a lot of barrels back.
They're giving themselves a little wiggle room there.
I mean, they can make a lot of money at $50 oil. Yeah. They can grow at 10% and make money at $50 oil. So they're in a good position.
Well, look, at 60% targeted rate of returns at $40 oil and $2.50 gas, if that's their threshold for drilling wells, then whether or not that includes consolidated corporate G&A or not, that ought to produce really good returns.
Right. And they also talk about, I agree with all that. If that all works, I mean, it's not going to work. It never works out perfectly. This is the oil industry and their technical feats and all kinds of things. But they also mentioned that that they're getting really good on the macro. So they basically say they're studying the macro intensely and they have a really good understanding, and not just oil price and everything, but so they will be monitoring the macro extremely, extremely close, and oil price, not just oil price, but all the things that impact it, to when they do this. And that is different, very different from Pioneer, because Scott Sheffield is extremely bullish on oil prices, and he likes to make calls and say things like, that Trump's not getting elected and everything, and know that he's right on certain things. But the only times I've ever heard folks be extremely bullish on, or I wouldn't say extremely, very certain of themselves on the macro. There have been a few of these, and Harold Hamm, Continental Resources, Mark Papa, former CEO of EOG, but CEO of Centennial Resource Development, they were very blatantly wrong, or they got it wrong, and they kept digging their heels into their views of the macro and taking their companies in that direction. I'm not saying Pioneer or Scott Sheffield is necessarily doing that. He is bullish, though. So he really sees that they have that he said that oil prices are going to go range bound 50 to 70. And he says we're clearly going to break out of 70 soon, and they don't look to hedge or anything. And that they, he sees consolidation. He sees consolidation as a very positive thing. So obviously of course you have to say that you just bought Double Point for a lot of money. And by the way, so our numbers, people corrected and said it was people told me, it's 100,000 barrels a day they bought. It's 92,000 barrel of oil equivalent per day. So that means it was 70,000 barrels of oil per day, probably, with a decent amount of gas. So they paid $6.2 billion, right? $6.2 billion for that? It was a crap ton of money for the company. Now, did give them, you can see the map, gave them some blocky, but look at the map. So they show Pioneer in slide 5. They show Pioneer as acreage, and they show Double Point. It is very blocky. It fits in really, really nicely, but it's not a lot, folks. It's not a ton of acreage. So it gets to the point of kind of of the theme of all this, in that the prices for this, it makes sense for these big guys need to buy up more acreage. It gives them more inventory, gives them more running room, more flexibility. So, I wouldn't say they had to, but clearly everything was in their favor to do it, and they went ahead and did it. And then Scott Sheffield's point about the consolidation in the market, because, Bank of America Merrill Lynch guy, I'm blanking on his name, British guy who likes to ask the theoretical questions. He asks, why don't, if you're all about not growing production, why would you buy this company? And Scott Sheffield says, well, we bought the company because, if more of us bought these small companies and then they reduced output, then would be in a better place. But at the same time, he also says that he doesn't think these small companies are going to move the needle on production. And it's kind of interesting because there's a lot of small companies that have increased the rig count significantly. So I think it's Embarrass who has us at 550, roughly 550, 543 something rigs for the U.S. total. And they include, that's much higher than Baker Hughes right now, but that's because they include everything, right? It's workover rigs, it's everything. And that, well north of 200 rigs and, we're right around 230 rigs in the Permian Basin. A lot of those rig additions have been from these private companies. And that is a serious bifurcation that you're seeing in the oil patch of, particularly in the Permian, of these private companies just going crazy. It's $65 oil. It makes sense for them to go crazy. They're going to go crazy all the time. And then of course they get asked, well, you're kind of enforcing that, right? They think they're going to get purchased, so they're just going to go crazy. And I thought some of them do, some of them may not. But if some of these guys do get purchased, especially in the Midland, let's talk Endeavor, Surge, Crown Quest, you name it. There's a lot of these small private companies that are hanging out in the Permian. And Endeavor's not public, are they?
I don't know.
Anyways, I could be blanking on that.
I don't think so.
You have lots of private companies within the Permian Basin, much smaller than that as well, and they're all adding rigs and they're all drilling. Now, if they get purchased by these companies, it does have a pretty big impact, I think, on the service sector in terms of the actual, who's fracking right now and who's running stuff. So, in addition to the fact that the service sector is kind of already, still has too much equipment and needs consolidation, this is another headwind for them.
They're not public.
That's what I thought. Yeah. Awesome. Good. Yeah. I'm not wrong about that. So that's great. So Pioneer talks about their compelling free cash flow, $23 billion in free cash flow from 2021 to 2026. They go on about their variable dividend as well, basically saying, they have their base dividend and then their variable dividend, and they think this is the best way to sort of return that money to shareholders. I just still think that, look, if it's variable, it's like, okay, if oil prices are good and things are running good, that's great. But if oil prices go down, and I think at the end of the day, shareholders still I guess they want to know their base, and as long as that's not changing, that's awesome. And then your variable sort of this icing on top, which is sort of what EOG did, just throwing out, your dollar per share.
Yeah, but again, paying any dividend as an E&P company in the United States,
absolutely,
from where we've come,
absolutely,
is great.
Absolutely. And so, they're growing, their target range is sort of growth at 5%. So you have to think about all these companies too. Again, I think it's important to think about, and even modest growth, if it's 1 to 5 to 10%, they have to add, a couple rigs. I don't think they're going to be adding a whole lot of frac crews given the trajectory, the longer laterals, or the incremental move toward longer laterals overall. And then the simultaneous fracs that I guarantee will continue to grow. So you're just not going to be doubling, I think, the frac fleets within the Permian, and the fact that many of those frac fleets are not fully dedicated, which means some of them that are just hanging out there, the one-offs, those will be pulled in. So this to me is just telling me that, these companies, it's important that they have, I wouldn't say hedging is not important right now, but the maintenance capital is something really important to think about, that they will have to maintain their spending. And because they're so big now, that spending is quite a bit. We're talking billions, millions and billions in the case of all these guys.
Shall we proceed to our friend of the show, Chris Wright at Liberty Oilfield Services? All right. Absolutely. We'll wrap up there.
Yes, we will wrap up there. So Liberty Oilfield Services. So really, in terms of wanting to learn about the market, if you're just looking for literally an earnings call to tell you the state of sort of the U.S. service market, it is a great call. I think Halliburton's call was actually pretty good on that as well. But Liberty sort of gets more into the weeds on things. So I thought it was a very interesting call, because Chris Wright opens up and talks about the state of the market. He basically, he does call out and say, I know everyone's telling you that they won't need your oil, but they couldn't be more wrong. So he's explains the whole how he sees the energy transition and everything.
And he is one of the industry's leading energy advocates, and I'd say a truth teller and peacemaker.
Yes, and he's so I've known Chris for a while, and so I think he does a good job of sort of explaining this market stuff, and he does a lot of research as well. He gets into a number of different interesting factors in here. So I mentioned they basically said they have 20%, they're fracking 30% of the wells, they have 15 to 20% of the market. And so with the OneStim acquisition from Schlumberger, obviously they have a huge, they purchased all this stuff and they have a lot of frac fleets. So running about 30 frac fleets. And from the ESG standpoint, I did think it was interesting, both from sort of the simultaneous frac perspective and then from an ESG standpoint and efficiencies. I mean, Chris Wright talks about like the efficiencies a lot. I don't know how many times he mentions it in the call, but efficiencies are huge. And so he does mention that, we're producing oil for the cost less than we did before. And that's in the face of what Ethan had just said, the fact that you're having positive free cash flow and all these things. The fact that you're lowering your cost per barrel for production, that we're continuing to do that is still really huge. And the fact that every operator, and many that I've listened to, and in addition to that, we haven't talked about specifically, but just efficiencies are loud and clear throughout all these calls of doing more with less. And I'm not saying that it can't go away, that you can't have, service cost, we can't have inflation, but it's just really important to realize that we have that in the face of $65 WTI. So, tailwinds for them were the same with 65 WTI, prices looking good. They did hone in on the market bifurcation though as well, is that you have a lot of these smaller companies that are adding, they're fracking more wells and they're doing stuff. And so they said, hey, we're seeing great capital discipline from the bigger companies and the majors and the publics, but we're not seeing that same capital discipline with these smaller guys. And so the smaller guys are making up a decent chunk of the pie. And it also means that I think, and we heard this from Halliburton as well, and I think from just overall my understanding of the industry, I think the second half of the year for the service sector could be counter-cyclically a little bit better. So we typically sort of start tapering off in third and fourth quarter, and as people have spent all their money. I don't think we're going to see the same thing. I think we're going to continue to see, at the very least, I think the third and fourth quarter are going to be pretty steady. And we may actually see some of these private companies, whether you're private equity backed. So we're back, more technical difficulties on a damn recording side. So anyways.
Don't get in trouble with your mom.
Oh yeah, my mom doesn't. She loved the podcast with Chuck Yates, except she didn't like all my cussing. And she thought the sound quality was better than this one. And I told her we didn't have a private studio. So anyways. Back to Liberty Oilfield Services. So a couple of big things in the call, in addition to the efficiencies and the bifurcation of the industry and everything, was that so they're doing an investor day in June, and then interesting. Chris Wright they are doing an ESG report that they're releasing June 1st. So it is not. I don't think this is going to be a typical ESG report. This is going to be a Chris Wright ESG report.
That's actually what I'm looking forward to reading. So
it'll be I think it will be very interesting, certainly interesting for the industry. And I think it's important to realize, like, he does have a different, he studied the market really well. He knows the stuff cold. And so we are seeing some differences in the, e-frac, electric frac, and the dual fuel frac fleet. So I think no matter what, all these frac fleets have to go toward that. There's a pressure and demand for lower carbon fracking, right? So EOG talks about the 5 electric frac fleets that they use. But I know probably 6 quarters ago, when somebody mentioned, or maybe 5 quarters ago, when somebody mentioned electric frac fleets, Halliburton and I think Liberty too, were basically like, yeah, we're not doing that. And of course, now they can't say that because the demand is higher, and they may, in theory, if they can get the efficiencies and if they can make them run better, they may, in theory, be able to charge a little more for them. But they do talk about the natural gas side, that they talk about using not a natural gas turbine on site, by using, and I would love to. I really do want to have a sit down with Liberty Oilfield Services, because I love the frac space, as you guys know, and talking about frac sand and everything, completions. But they talk about the using a natural gas reserve engine versus a natural gas turbine on site for fracking, and that they see that is a significant difference on the frac side from an efficiency standpoint, especially from a fuel use standpoint. And I do think it's a clear trend. It's a clear trend in the industry that they are. The need for dual fuel, the ability to do being powered by natural gas is important. And then I also think just the overall efficiency. So if you are not running as efficiently with a natural gas system versus a diesel system from a power standpoint, that's not going to work either. So I think this is going to continue to evolve from you have to have the choice of, and I'm happy for somebody to get on here and get deeper into the weeds on this. But from my understanding, from what I've heard, especially from Halliburton and Liberty in their calls, was that, the need for multi-fuel is like, that's an automatic. You have to have that or you're going to be pushed out. And then increasingly, you're probably going to need to provide greener and greener options on a lower emission standpoint, lower GHGs for your clients.
Yeah, I think that's a clear trend. Well, with that, I think we are at a natural stopping point, unless Trisha wants to say one more thing.
No, I just, he's got to say it's a natural stopping point. He never just lets me naturally. So it is the natural stopping point, and we probably should conclude because we've been talking a while.
Always a minefield. Well, thanks for joining us for episode 16. I'm Ethan Bellamy, and this is Trisha Curtis. We wish you well, and we'll see you again soon.
Thank you guys so much. Bye.